So I recently posted this video on my warning to index investors in 2022. The video was largely based around the data from this website, which looks at the historical valuation of the S&P 500, and right now it does seem to be pretty expensive. But for long-term investors, I don't think this is an issue. The warning was mostly for those people that chase historical returns and have unrealistic expectations about the future. But I did get a few comments on that video asking, where's a good spot to put your money in the market right now? So that's what I'm going to try and tackle in this video. And as always, if you guys enjoy what I do, leave a like, subscribe, and let's get into it. Okay, so where to begin? This is a list of the 100 equity ETFs with the lowest PE ratios. And in my opinion, for finding discounts, I think a list like this is completely worthless. Because when it comes to PE ratios and the multiples applied to earnings, there's a concept you have to understand. Because it's never as simple as low valuations are good and high valuations are bad. There's a lot more to it than that. And to try and illustrate this point, I have two little infographics right here. So this green line represents the earnings of a company, and the blue line is the actual valuation, which applies a multiple to the actual earnings. And the bigger this gap between the two, the higher the valuation or the PE ratio. But if I come over to this example right here, this illustrates more of a growth company because the earnings are growing a lot faster. And here, these high growth names tend to have higher PE ratios because the actual earnings of the company is growing at a faster rate, commanding a higher multiple. And usually along with the higher multiple comes with it a higher level of volatility on top of that. So the fundamental earnings of a company are the number one indicator, at least in my view, of the long-term direction of the value of a company. But the point I'm trying to illustrate here is all because one company has a higher valuation than another doesn't mean that it's a worse investment. So you don't always want to look for cheap, you want to look for quality. Okay, so let's take that knowledge and try and apply it to the current market situation to try and identify some deals. Okay, so here I have a couple broad market ETFs that represent different segments of the stock market. We have the S&P 500 with a PE ratio of 25. We have small cap, we have large cap growth, value, as well as high growth tech names represented by IGV. And this is what they all look like together on a chart. And to me, there's two distinct groups here. The first group is the low valuation stocks. And in the past 1 year, these have done phenomenal, keeping pace with the general market, which is the dark blue line. And this is actually an overperformance compared to their historical average, because if we zoom out to the 5-year view, these names tend to underperform the market. Now, don't get me wrong, these are quality names, but the reason why they tend to underperform over long periods of time is because their earnings growth is just less, and that's why they're value companies, broadly speaking. And the second group has the exact inverse situation going on, and these are the high multiple tech names. Over the past 1 year, these names have done extremely poorly against the overall stock market, and usually, historically speaking, these names tend to have more price appreciation than the market. And for me personally, this is how I identify value in the market. You have to go against what everybody else is doing. So right now, everybody is in love with low valuation names, and thus they've overperformed, and relative to their history, they're pretty expensive right now. And high growth names, they usually overperform the market, recently have been trading down, potentially creating a good buying opportunity. And this ability to fight the grain and go against your emotions is actually a skill that you as an investor have to develop over time. In fact, here's a clip from DataDash talking about this exact topic. He's a great crypto-focused investor, but the principle applies to all asset classes.
I think a lot of us sometimes can get a little too greedy when it comes to our expectations. And along with that as well, we can get a little too fearful when things go south, when things don't go our way. I even have it sometimes. I remember back during the March 2020 correction, I was in New York, and of course with all the macro news that was going on at the time, I remember watching Bitcoin's price sink, and I thought, oh my gosh, is this really it for crypto? And lo and behold, that was the best point to buy into the market. It's absolutely insane. You have to go against your emotions. It's a habit that you have to build. And you have to go against the general sentiment of what everyone's saying. So when everyone's panicking, you got to be like, oh, cool.
All right, now here's the final thing I want to say on this topic. So this is a clean view of the S&P 500 in blue and IGV representing high growth tech names in yellow. If you guys recall back to 2020, this is when everybody wanted to buy these high growth tech names. And then at the end of 2020 and the beginning of 2021, there was this massive rotation in the market away from tech and into value. And because of that, now in 2022, you can buy IGV for the same price it was back in December of 2020. Now for comparison's sake, this is the same chart but with SCHD, which represents low valuation valuation companies. And here we have the exact inverse. Back in 2020, nobody wanted to own banks, financials, and these low growth names. But in 2021, with this rotation, it's the exact opposite. And now if you want to buy shares of this ETF, it's going to cost you significantly more than it did back in December of 2020. So to me, this is just another example of how if you want to find discounts and value in the market, you have to go against what everybody else is doing. And tying this back into my portfolio, my growth assets have been slaughtered over the past 1 year, and my income assets have done phenomenal. And trust me, every ounce of my body wants to take all of my new deposits and dividends and buy my income assets. But I know from experience that this is not the time to buy income assets. This is the time to take all of my new deposits and buy growth assets as they sell down. And to quickly give my personal view on when I think this pain around interest rates is going to stop, I think it's going to stop once interest rates actually go up. I once heard that the worst thing that could happen for recovery stocks is for the stock market to actually recover. In my view, all of the news around the Fed has already been priced into the stock market, and there's just this anxiety right now before it actually happens. But once it happens, it's usually not as bad as people fear. And I'll leave you guys with one final piece of advice before I go. If you're looking for a generic way to find potential dips in the market, I personally love to use the VIX, which is a measure of fear and volatility in the market. And just roughly speaking, whenever it's above 20, that's when I begin to look at buying opportunities. So that's a very simple way to approach this if you prefer that method. That's going to be the end of the video. Hope you guys enjoyed. If you did and you're still watching, leave a like, subscribe, all that YouTube stuff, and I'll see you guys in the next one.